here's something that surprises most people the first time they hear it. The wealthiest families in America, the ones with real estate portfolios, private businesses, and multi-generational fortunes, are often buying massive life insurance policies. Not small ones, sometimes policies worth tens of millions of dollars. And here's the twist. They're not buying it because they're worried about dying. They're buying it because it's one of the most powerful and most misunderstood financial tools available in the American tax code. By the end of this video, you'll understand exactly why. Stick around because reason number 4 is the one most people have never even heard of. Quick disclaimer before we start. This video is for educational purposes only. It's not personalized financial, tax, or legal advice. Insurance products are complex, rules vary by state, and you should always talk to a licensed professional before making decisions with your own money. With that said, let's talk about life insurance. Not the way it's usually sold to regular families, but the way it's actually used by high net worth households. Most people think of life insurance as a safety net. You pay a small monthly premium, and if something happens to you, your family gets a payout. That's true, and it's a great tool for everyday families. But for the wealthy, life insurance plays a completely different role. It becomes a tax shelter, a lending tool, a business protection strategy, and an estate planning weapon, all at once. In the United States, when someone with a large estate passes away, their estate can be subject to federal estate tax. As of 2026, the federal estate tax exemption is in the millions of dollars per person. But for very large estates, anything above that threshold can be taxed at rates up to 40%. Let's imagine a business owner we'll call Mr. Harmon. Mr. Harmon built a manufacturing company over 30 years. On paper, between his business, real estate, and investments, his estate is worth $30 million. If Mr. Harmon does nothing, when he passes away, a significant portion of that estate could be owed to the federal government in estate taxes. His children might be forced to sell the family business, real estate, or investments just to cover the tax bill. This is where life insurance comes in. Instead of leaving his heirs a tax problem, Mr. Harmon purchases a large life insurance policy, often owned by a special trust, rather than by him personally. When he passes away, the policy pays out a death benefit. And here's the key part. Life insurance death benefits are generally received income tax-free by the beneficiaries under federal law. That tax-free payout can be used to cover estate taxes directly, without touching the family business or other assets. The company stays intact. The real estate stays intact. The family keeps control of what took a lifetime to build. This single strategy is one of the biggest reasons wealthy families use life insurance. Not to replace lost income, but to preserve a legacy. Now, here's where it gets interesting. Because simply owning a life insurance policy isn't enough. If Mr. Harmon owns the policy in his own name, the death benefit could actually be counted as part of his taxable estate, which defeats the purpose. So wealthy individuals often use something called an irrevocable life insurance trust, commonly known by the acronym ILIT. Here's how it works in simple terms. Instead of buying the policy himself, Mr. Harmon sets up a trust. The trust buys the policy and owns it. The trust pays the premiums, often funded through annual gifts within legal gift tax limits. When Mr. Harmon passes away, the death benefit is paid to the trust, not to him personally, which means it's generally excluded from his taxable estate. The trust then distributes the funds to his children according to rules he set up in advance, potentially years or even decades earlier. This structure accomplishes 3 things at once. It removes the policy from the taxable estate. It protects the payout from creditors and lawsuits in many cases. And it lets the person control exactly how and when their heirs receive the money. For example, releasing funds at certain ages or milestones, instead of all at once. This is estate planning at a level most people never see, because it's not something a bank teller or a basic financial app is going to explain to you. It requires an estate attorney and a specialized insurance strategy. Now let's talk about a completely different category, permanent life insurance with cash value, specifically whole life and certain types of universal life policies. Unlike basic term life insurance, which only pays out if you die during the policy term, permanent life insurance builds up a cash value over time, A portion of every premium payment goes into this cash value, and it grows on a tax-deferred basis. Here's what makes this powerful for wealthy individuals. That cash value can be borrowed against. Let's use another example. A fictional investor named Diane, who runs a real estate investment firm. Diane has a permanent life insurance policy with a substantial cash value built up over many years. When she finds an investment opportunity that requires quick capital, instead of selling stocks and triggering capital gains taxes or going through a lengthy bank loan process, she borrows against her policy's cash value. The loan typically doesn't require a credit check. There's no rigid repayment schedule like a traditional loan. And the remaining cash value in the policy usually continues growing even while a portion is borrowed against, because the loan is technically taken against the insurance company using the policy as collateral, not withdrawn directly from the account. This concept is sometimes referred to informally as becoming your own banker. It gives wealthy individuals liquidity and flexibility without disrupting their long-term investments or triggering unnecessary taxable events. It's not free money. Interest accrues on the loan, and policies need to be structured and managed carefully with a professional. But for people with significant cash flow, it becomes a flexible financing tool that most middle-class families never get access to, simply because it requires a large enough policy to make it worthwhile. This is the reason most people have never heard of, and it has nothing to do with personal estate planning. It's about protecting a business. Imagine two business partners who co-own a successful company. We'll call them Partner A and Partner B. They've built the business together for 15 years. Now imagine Partner A unexpectedly passes away. Without planning, Partner A's ownership stake typically transfers to their spouse or family. Suddenly, Partner B is now running a business with a new, unplanned business partner who may have no experience in the industry, no interest in running the company, and completely different goals. To prevent this, business partners often set up something called a buy-sell agreement funded by life insurance. Each partner takes out a life insurance policy on the other. If one partner passes away, the death benefit provides the surviving partner with the exact funds needed to buy out the deceased partner's share from their family at a fair pre-agree. The result: the surviving partner keeps full control of the business. The deceased partner's family receives a fair cash payout instead of an ownership stake they can't manage. And the business itself keeps operating without a disruptive ownership fight. There's also a related concept called key person insurance, where a company insures the life of a critical executive or founder, the person whose knowledge, relationships, or leadership the business depends on. If that person passes away, the payout helps the business cover lost revenue, recruiting costs, and the transition period while they find new leadership. This is why, behind the scenes, many privately held companies you've never heard of are carrying life insurance policies on their owners and top executives. It's not personal. It's a core part of business risk management. Life insurance also plays a role in how wealthy families give back, in a way that benefits both the charity and the family's tax situation. One common strategy is naming a charitable organization as the beneficiary of a life insurance policy. This allows someone to make a much larger charitable gift than they could by simply writing a check during their lifetime, because the death benefit can be many multiples of the total premiums paid. Another approach involves what's sometimes called wealth replacement. Here's how it works. Imagine someone donates a highly appreciated asset, like stock or real estate, to a charitable trust during their lifetime. This can provide meaningful tax benefits and support a cause they care about. But it also means that asset is no longer available to pass on to their children. To solve this, they take out a life insurance policy with a death benefit roughly equal to the value of the donated asset. When they pass away, their charitable gift is already made, and their children still receive an inheritance through the life insurance payout, effectively replacing the wealth that was donated. This lets families support causes they believe in, without feeling like they're choosing between charity and their own children's inheritance. If you've been listening closely, you've probably noticed a pattern. Almost none of these strategies are really about the emotional idea of life insurance most of us grew up with, protecting your family if you die too soon. For wealthy individuals, life insurance functions more like a financial Swiss Army knife. It's a tax-free wealth transfer tool. It's a way to keep assets out of a taxable estate. It's a source of flexible private liquidity through cash value. It's a business protection contract, and it's a charitable planning instrument. The death benefit is almost secondary. The real value is in the structure, how the policy is owned, who controls it, and how it interacts with the tax code while the person is still very much alive. This is also exactly why these strategies aren't widely known. They require large policies, ongoing premiums, and professional guidance from estate attorneys, accountants, and insurance specialists. They're not something you stumble into by buying a basic policy online. They're built deliberately, often over decades, as part of a much bigger financial plan. Now, you might be thinking, this is interesting, but I'm not managing a $30 million estate. Does any of this apply to me? Here's the honest answer. The scale is different, but some of the underlying principles still apply to regular families. Term life insurance is still one of the most affordable ways to protect your family's income if something happens to you. Permanent life insurance with cash value can make sense for some people, but it's more expensive and more complex, and it's not automatically the right choice for everyone, despite how it's sometimes aggressively marketed on social media. The bigger lesson here isn't go buy a complicated insurance policy. It's this. The wealthy don't think of insurance as an expense. They think of it as a financial structure, a tool that solves a specific problem, whether that's taxes, liquidity, or business continuity. Whatever your financial situation, asking what specific problem is this financial product solving for me is a much more powerful question than should I buy this because someone told me to. So that's the real reason wealthy families use life insurance. Not fear of dying, but smart, deliberate financial engineering. Tax-free wealth transfer, estate tax protection, private liquidity through cash value, business protection through buy-sell agreements, and charitable legacy planning. None of this is a secret hidden from regular people on purpose. It's just complex. It requires professional guidance, and frankly, it's not something most banks or basic financial advice ever covers. One more time, this video is for educational purposes only, not personalized financial or tax advice. If any of these strategies sound relevant to your situation, talk to a licensed financial advisor or estate attorney who can look at your specific numbers. If you found this breakdown valuable, hit subscribe for more deep dives into how the wealthy actually manage their money, not the surface level tips, but the real structures behind the scenes. Thanks for watching, and I'll see you in the next one.